So Vanguard have finally cut the fees on some of their UCITS equity ETF range, but is it too little too late given how competitive the UCITS ETF market has become? Well, in this video, we'll take a look at what exactly the fee cuts are, which ETFs have had their fee cut, how that compares to other ETFs in the space, and are they really that cheap compared to what other options we have? Also, we're going to consider the impact of fees. Are fees even that important? And spoiler alert, fees are important, but of course, there are always other things to consider. It's not as simple as the lowest fee ETF is the best. As always, before we dive in, this video is for informational, educational, and entertainment purposes only. I'm not a financial advisor, and this is not investment advice. When investing, your capital is at risk, and you may get back less than invested. Past performance doesn't guarantee future results. Please do your own research. Okay, first things first, let's go take a look at what exactly this fee cut is. What has Vanguard changed? So here we are on the Vanguard fee cut page. We've lowered our ETF costs again. Our latest fee reductions will let investors keep even more of their returns and improve their chances of investment success. But just a quick bit of context before we go any further. Some people get confused between Vanguard the platform and Vanguard the fund provider. So in the UK, we have Vanguard the platform where you can open a stocks and shares ISA, self-invested personal pension, general investment account, and then within that account, you can pick investments, Vanguard funds, like the FTSE All World, the Vanguard S&P 500, the Vanguard FTSE Developed World, Vanguard FTSE Japan. These are Vanguard funds, the actual investments you pick within the account. Now, the key difference is you can hold these Vanguard funds on pretty much any investment platform. So you don't have to have Vanguard's platform to invest in their funds. So in this video, we're talking specifically about fee cuts on their funds, not their platform. So it doesn't matter what platform you use, these fee cuts apply because the fee is basically baked into the ETF. It doesn't matter what platform you buy it on. I do also find it a bit ironic that they're saying our latest fee reduction will let investors keep even more of their returns. And this is after they increase the platform fees for people with portfolios of lower than £32,000. So they're trying to say here that lowering fees is a good thing, whilst on the other hand, they increase fees for their platform. So here we are. We'll go through these one by one, and then we'll focus on the top one because I feel like this is the one that most people will care about. So the Vanguard FTSE All World had a previous ongoing charge figure of 0.22%. That's dropping to 0.19%. So that's 0.03 percentage points. Vanguard FTSE North America. So this will include Canada as well. So that'll be the US and Canadian stocks. That's going from 0.1% to 0.08%. Vanguard FTSE Emerging Markets, 0.22% to 0.17%. Vanguard ESG Emerging Markets, 0.24% to 0.19%. Vanguard FTSE Japan, unhedged, 0.15 to 0.1, and then hedged, so currency hedged, GBP hedged, from 0.2 to 0.15. Last one, Vanguard Germany All Cap, down from 0.1 to 0.07%. So it's great to see these fee cuts, but the one we're going to focus on in this video is the one that probably most people will care about and will affect the most investors by far, the Vanguard FTSE All World UCITS ETF. So that is now 0.19%. The key question is here, how does this compare to other providers? Is this that competitive? Well, I've just done a video on the lowest cost ETFs for UK investors, and 0.19% is definitely not going to make them the lowest cost. As we'll explain a bit later in the video, it's not all about fees, but let's head over to just ETF now, just for a quick comparison to see where Vanguard stacks up now with this lower fee. So when it comes to truly global ETFs that include stocks from both developed and emerging markets, there's only 4 indexes they track, and for UK investors, it's actually only 3. Let me explain why. So you have the FTSE All World, MSCI All Country World, MSCI All Country World Investable Market, and Selective GBS Global Markets Large and Mid Caps. Now, for UK investors, there is no ETF that tracks the MSCI All Country World Investable Market Index. It says there's one ETF here, but that ETF trades in euros and I think US dollars as well. So we could buy that in our portfolios, but we would have to incur FX fees because there's no listing in GBP. Whereas for the other ones, they do have listings in GBP. The difference between MSCI All Country World and MSCI All Country World Investable Market is that the Investable Market one includes small caps, whereas all the other indexes here are just large and mid caps. So it is a bit more diversified, and it is a shame there is no GBP listing, but that's what it is. Now for the FTSE All World, there's only 2 index providers that offer ETFs that track it. Vanguard and Invesco. And Invesco launched their ETF a couple of years ago now, and that has a low fee of 0.15%. So they haven't tried to beat Invesco here, which is surprising because Invesco obviously undercut them. And you'd think if Vanguard wanted to be truly competitive, they'd try and undercut Invesco, but they haven't tried to do that here. So that tells me they're relying on the brand loyalty, the brand recognition, that people recognize the Vanguard brand more and probably more likely to go with Vanguard over Invesco, even though it has a higher fee. So they're obviously relying on that brand recognition. There is obviously, in terms of sampling, I think the Vanguard ETF contains more stocks than the Invesco ETF. But yeah, it's not the cheapest FTSE All World ETF. Now, we can also compare it to the MSCI All Country World Index ETFs. With these ones, FTSE and MSCI are both index providers. This is just MSCI's version of the FTSE All World. There's small differences, but nothing that investors should really concern themselves with. And you can see here, they have now actually undercut the iShares option. So iShares, operated by BlackRock. So that is their main competitor really in terms of fund provider, like size of fund provider. So they have undercut BlackRock. So that's a good sign in terms of competition for them. But they are quite far behind the State Street MSCI All Country World Index ETF. That one had its fee cut from 0.4% to 0.12% in August last year. So that is a really competitive option. Full transparency, regular viewers of the channel will know that's the one I currently have in my portfolio. So Vanguard have not tried to undercut that option here either. And then the last one we'll quickly look at is the New Amundi one that launched in February this year, tracking the Solactive Index, less well-known index provider, but still developed in emerging markets, truly global. That comes in at 0.07%. So you get the picture here. Vanguard is not trying to be the cheapest option. They're just trying to make themselves a little bit more competitive and clearly relying on the Vanguard brand name to hopefully sway investors over the other options despite not being the cheapest. In the next part of the video, I wanted to do a quick calculation on the impact of fees. And do fees really matter? Are they that important? Because we obsess over them quite a bit. But what actually happens if we had identical ETFs that delivered the exact same performance before fees? What are these small differences in fees actually doing? Because 0.01 here, 0.02 here, like we can get a bit obsessed. Do these very small fee differences actually matter? And you can see here with Vanguard's old total expense ratio for the FTSE All World, the future value of a portfolio would be 823k. And now with the new fee, 0.19%, based on these assumptions, you'd end up with 826k. So you can see, like, that's obviously great, an extra 3k, but it's hardly going to be the difference between achieving financial independence, financial freedom or not. So these fee cuts are nice, but I do think this kind of brings it back to reality how it's not going to be the be-all and end-all in terms of achieving your goals. Then with the 0.15% option, 830k, 0.12%, 834k, 0.07%, 839k, and then no fees would be 847k. Now, whilst I've done these TER intervals to represent different ETFs, please keep in mind this is not a reality of what these ETFs will deliver because there are differences between them. We're making the big assumption that these ETFs are absolutely identical in terms of performance and the only difference is the fee. In reality, that is not going to be the case. Which brings me on to the next part of the video, reality check. Fees aren't everything. So these are other things to consider beyond just fees, and whilst it can be dangerous to obsess over fees. First up, index methodology. Small differences in country sector exposure. So a 0.02, 0.03, 0.05 percentage point difference in fees could be completely outweighed by a very small difference in country sector stock exposure that completely changes the performance by, say, 0.2%. So 0.2% is not a big deal, but obviously that's a much bigger deal than the small fee cut, if you get what I mean. So even though I say these indexes are extremely similar, these tiny differences could make a bigger difference than the fees. Same with replication methods. So you can either have a physical full replication, so it holds all the stocks in the index, physical sampling. So two ETFs may track the same index, but they have different sample sizes. That's, of course, going to impact the performance. They include a different sample. That sample they pick could perform slightly better or slightly worse. Fund size and liquidity. So this is a key one with Vanguard. One thing that Vanguard's usually going to always win at is fund size and liquidity because Vanguard funds are so popular, they tend to have some of the biggest funds. Why is this a good thing? It just means that there's almost zero chance of the fund closing because the fund provider's size is not worth their time. Vanguard's not going to decide that their funds are not worth their time with like the global fund, for example, because it's so big. But saying that, none of the other competitors are particularly really small, so that's something to consider anyway. The bigger reason why fund size is important here is liquidity and bid-offer spread. So this is the difference between the price you can buy a share of an ETF at and the price you can sell it at. For Vanguard funds, this tends to be absolutely minuscule. We're talking like 0.01, 0.02 percentage point difference between the bid and offer price. So you don't lose anything on transaction, whereas these newer ETFs might have lower fees, but the spread will be wider. So on transaction, you're losing more on transactions. That's another thing to consider. Tracking different. So this is the performance between the ETF and the index it tracks. This is usually a result of the total expense ratio, the replication method, and that will impact the tracking difference. So what you could notice sometimes is that a fund might have a higher total expense ratio, but actually track the index better because of the sampling method they use, or maybe they're getting extra income from share lending, whatever it may be. And then lastly, accumulating versus distributing versions. Not all options by fund providers will have both. So you might really like the Amundi option, for example, but it doesn't have an accumulating version for UK investors. So if you wanted that, you wouldn't be able to go with that option. So in summary, fees aren't everything, but of course, fees are important. I just wanted to put this context here after doing the calculations, because the calculations were based on a perfect scenario where there were no differences. In reality, there are other differences between the funds. So what's my verdict on these Vanguard fee cuts? Simply put, it's great to see Vanguard cutting fees. Of course, they're not the cheapest, but they are relying on that brand trust, brand recognition to keep people invested in their funds and attract investor inflows as well. Because quite simply, if you search how to invest for beginners, you're probably going to see people talking about Vanguard funds. They've just managed to completely dominate that space on the internet. It's always people talking about Vanguard. However, the other fund providers, Invesco, State Street, Amundi, iShares, they're all massive fund providers in their own right. So we shouldn't write off these other options and think Vanguard's the only trustworthy provider. That's just simply not the case, in my opinion. And in general, to sum up with fee cuts, as I've alluded to, these tiny differences in fees aren't going to be what leads to you achieving your financial goals or not. What's more important is picking a fund that you stick with, consistently contribute, seek to increase your income to increase your contributions. A small increase in your contributions is going to be way more important than constantly switching to try and find the cheapest ETF by 0.02 percentage points. In summary, the key drivers of your success are going to be consistent contributions, using the right tax-advantaged accounts, whether that be an ISA or a pension. The right split will be completely different depending on the individual, so I can't comment either way whether an ISA or a pension is better for you. In most cases, it's probably a combination of both, but if you're unsure about which account to prioritize, that's where you should probably seek help from a qualified financial advisor. Increasing your savings rate, so that could be through increasing your income or decreasing your expenses. The more you save, the more you contribute, the greater your final portfolio balance is going to be. Sounds simple, but a lot of people prioritize small performance differences over increasing their contributions. And most importantly, having that long-term mindset, staying invested through volatility, accepting that volatility, drawdowns, crashes is part and parcel of investing, and constantly switching, trying to time the market will probably do way more harm than anything else that happens in your investing career. One wrong timing of the market can set you back a long, long time, unfortunately. If you've watched this far, thank you for watching, and leave a thumbs up emoji in the comments below so I know that you've reached it to the end. And also, there's another quick opportunity to just say thank you to all the regular viewers of the channel, especially the regular commenters. It's really nice to build that small community, and I really like seeing the familiar names in the comments. I can't stress enough about how those comments keep me motivated, and I really do appreciate everyone who views, likes, and comments on the channel. I'd also like to share the news that I've recently been nominated for a Finfluencer Award. It is a bit surreal, and I do have a bit of imposter syndrome when I see other people that are going to the event, but I'm really looking forward to it. And I will leave a link to it in the comments below if you'd like to show your support and vote for me. Of course, no obligations at all there. It's there for you to check out, and you can also vote in other categories for some of your other favorite creators as well. As always, thank you for watching, and I'll see you in the next video.